Let's talk markets. It will be a half day of trading today because of the Independence Day holiday. Markets will close at 1 p.m. Eastern. We got futures higher this morning leading into the day, up 130 points on the Dow Industrials, up 40 points on the NASDAQ, extending the momentum that we saw at the end of the day yesterday. Joining us right now is Wells Fargo Investment Institute Senior Global Equity Strategist Scott Wren. Scott, good to see you this morning.
Hey, Maria.
What's your take on market second half of the year? We had obviously a down first half of the year. We've got these new trade tensions that people are focused on. Where's the market's focus today?
Well, I tell you, Maria, I think, you have some issues. For a while they're on the front burner, then they're on the back burner. Clearly now trade is back on the front burner. And I think really the balance of this year, you're coming into the midterms. I don't think there's going to be a big change. There's going to be issues. There's going to be volatility. But I think in the end, there's going to be opportunities created by that volatility. And really, if you look back, you look back to February 9th, the first time we touched the 200-day moving average. I mean, literally, we have touched the 200-day moving average about 7 times and come close on 5 or 6 other trading days. And if your forward outlook is good, I mean, you have had a lot of opportunities to put money to work here. And I think that's what we're trying to encourage our clients to do. So, we want to take advantage of this volatility.
So let's look forward. Lindsay Bell is with us this morning. And Lindsay, we had a really good earnings period in the first quarter, up 26% on S&P 500 earnings. Or was it 28% on?
Yeah, it depends on whose numbers you're looking at.
S&P 500 earnings. What are you expecting for the second half of the year in terms of the backdrop for investing?
Well, we have a great backdrop, on average about 20% growth for the second half of the year. 2018
in earnings?
In earnings. 2018 total should be 20.9%. 10% growth in 2019. You get a little bit of a slowdown as we work through the tax reform. But Scott, I'd love to get your take. We're overweight tech and growth. It's been the leader this year. We came into this year really thinking the value could maybe take the lead, but it really hasn't been the case given all these issues that we've already discussed here. Do you think that growth in tech and those types of sectors continue to lead as well as the small caps, or what's your outlook for the second half?
Yeah, hi, Lindsay. Good morning. We, for us, technology, we had been overweight technology for quite a while, but we cut back in 2017. We just thought, once we breached that 25% of the market cap of the S&P, we thought that was kind of a level we wanted to be careful with. So, we're fully invested in tech. Certainly growth, I don't see any reason why growth would not outperform looking forward. I mean, we want our clients leaning toward these sectors that are sensitive to a continuation of the recovery. So there's been, clearly when the market pulls back, things like industrials don't do well when it's trade issues. But, really industrials has done pretty well over the last couple of years. I think it's stumbling a little bit right now. I think it'll do better in the second half of the year. But we like consumer discretionary. We like financials, which have obviously stumbled when the 10-year yield's down this low. So, those are some sectors that, based on their recent performance, I think have offered some opportunities, because I think when you look down the road over the course of the next 12 months or so, those are going to be the kind of sectors that outperform.
Scott, one of the things that's changed this year is the global growth story. At the beginning of the year, everyone was talking about synchronized global growth, how Europe and China and the whole world was kind of getting on the U.S. growth bandwagon. It's gone another way. The U.S. growth has picked up in this second quarter, but Europe looks like it really hasn't come back from its soft first quarter. China is kind of slowing down. How do you see the global growth outlook playing out in the second half of the year, and what does that mean from a portfolio perspective?
Well, John, I think for us, and, when I look at the market, I mean, to me, the two biggest risks are the Fed and global growth. I think, a trade war is a relatively low probability. You could argue that the rhetoric lately has increased the probability, but I still think, the Fed and global growth. Our economists think global growth is going to hang in there. I think there's reasons to be concerned. Certainly some of this first quarter data was not very good, but it's picking up a little bit here. And it's going to be interesting because a lot of the things that are going on in those markets right now, I mean, clearly emerging markets have been whacked this year. The IFA index has been hit too. But I think in the end, this growth is not going to slow down very much. It's still going to be there. I don't think it's really going to accelerate. But, you know, S&P 500 companies and earnings for S&P 500 and our earnings estimate, I mean, we need some help from these international markets. And I think we're going to get it from both the IFA, the developed international markets, and I think from the emerging markets as well. So we want to be fully invested there, but we're not, you know, pounding the table or anything like that.
I know we're expecting a good second quarter, but what about the June jobs report that we're expecting Friday? The expectation calls for 195,000 jobs added to the economy. The unemployment rate is expected to hold steady, 3.8%. What are your expectations, and how much of this is priced into the market, Scott?
You know, I tell you, Maria, you know, that May report, I mean, that was a Goldilocks employment report. Really good job growth, wages that were modest. And so I think that I don't know if the report's going to be that good this time around, but, you know, 190,000, anything around there, I think is a good number. And, you know, the average hourly earnings number, I believe that's the biggest number we're going to get every month in that report. It's expected at 2.8, and there's really almost a red line right now, I think, at 3%. And, you know, the market's going to be focused on margins, cost pressure, and wage pressure is a really, really big one. So 3% is a danger level, but I think we're going to be below that. But certainly the labor market's tightened up, and I think this is going to be a good report.
All right, we'll be watching that wage number. Scott, good to see you this morning. Thanks so much.
All right, guys, have a good 4th.
And you too. Happy 4th of July.